this year. For more insight, though, on that potentially here and the early morning activity that we're seeing already, let's bring in Thomas Hayes, chairman of Great Hill Capital. Thomas, if I may here, got to get to that bit of breaking news this morning. Seeing another major company pull out of Russia is pretty significant. I mean, it follows McDonald's. This morning I heard EY, even Deloitte. I mean, you're seeing a wide scale kind of full retreat out of Russia from major American businesses. When you see that, what do you think?
Well, I think they're going to keep the pressure on Russia until Russia finally complies and exits the invasion of Ukraine. So at some point, the pain is going to be so severe that the oligarchs will take matters into their own hands, and this may get resolved. But until then, the pressure is going to continue to be on full force, and Starbucks is the latest in that iteration.
You know, on the flip side, from the impact directly to Russia, when you think about the impact to investors, Starbucks is only about 1% of its revenue. For McDonald's, it was a little bit more significant. I think about 9%, 10% of its revenue. What's the impact to investors, and what should investors be looking out for?
Well, I think they should expect that many more companies are going to start to exit Russia moving forward. I think for many multinationals, Russia is a de minimis portion of their revenues, with the exception of the McDonald's. But the McDonald's sold the franchises to the franchisors in Russia, so they made some money on that transaction. And by and large, what we're going to find out moving forward is it's really not going to impact the earnings of the S&P 500 in a material way.
You know, the issue, obviously, the geopolitical kind of concern with Russia is only one of many factors weighing on the markets, especially over the last couple of weeks. To the tune that I mentioned there a moment ago, you know, you got the Dow on an 8-week losing streak, its first since almost a century. We saw last week another turbulent week. Last Wednesday, I mean, the Dow losing 1,100 points, trying to kind of rebound toward the end of the week, but that not happening. Hopefully, we're looking to see if we see one of those rallies today. But when you look over the past week and just the volatility we've seen in the market, what are the biggest concerns for you, or you think the biggest things really pulling back and weighing down the market?
Yeah, Alicia, the selling that we've seen, particularly in the last 2 or 3 weeks, you know, I've been in the markets for some time. It felt very unnatural, felt a little bit disorderly. And I think what you're finding it was a function of certainly margin calls, but fund redemptions. And what was interesting about last Wednesday, which you noted, was Melvin Capital of the famed meme trade, got the short squeeze with GameStop, et cetera. They sent a letter to their investors that they were winding down the fund. Now, no one in the hedge fund business is going to send a letter before they liquidate the positions. So we kind of have some insight as to where some of the selling pressure may have been coming from over the last few weeks and why it was disorderly. And I think Wednesday could have potentially mark the bottom. You know, you saw $17 billion of tech losses for Tiger Global. So all of these funds not only taking the losses, raising cash, dealing with their volatility metrics, but also getting redemptions from investors. But I do think that this may be in the rearview mirror at this point, and it may create a bottom to really find some high quality bargains moving forward.
Well, bottom would be nice. I know a lot of investors kind of, you know, last week, I can't tell you how many times I've heard people, is this the bottom? Is this the bottom? I walked into the NYSE today, and even one of the security guards said, do you think we've hit it yet? You know, I'll let them know that you think we have. If we're rebounding, then, if the idea is that we're going to kind of rebound, is it going to be a slow and steady rebound? How is that going to look?
Yeah, well, look, no one, you know, the old saying, he who picks bottoms gets stinky fingers. So no one can say with high probability, but when you look at the statistics, what we saw in the Bank of America Global Fund Manager Survey last week, highest cash balances since the Great Financial Crisis and since 9/11. Those were generational buy opportunities. Most underweight stocks since May of 2020, which was near the pandemic lows, generational buying opportunity. And the biggest, one of the most crowded trades is short tech right now. The last time managers were this short tech was August 2006. Over the next 18 months, the NASDAQ composite was up 42% off of those lows. So I think, you know, if you look at those metrics, if you look at the National Association of Active Investment Managers, they're down to 20% equity exposure, which is the lowest since the pandemic lows. If you look at CNN Fear and Greed, it's at 11. Historically, that's a buy place. You want to be a buyer, not a seller. And then AAII sentiment last week came in at 50.4% bearish. At the bottom of the pandemic, it was 52% bearish. So, the extremes don't get much more serious than they are right now. And when they're that extreme, and then you take into account, Alicia, the multiples on stocks are below the 5-year average of 18.6 times. We're trading at 15.5 times next year estimated earnings. So not only do you have this structural fear in the market where we've kind of exhausted most of the sellers, but now the valuations are looking attractive for fundamental-minded investors to step in on a selective basis, buy stock, buy sector, not wholesale buy everything and hope the market rallies to new highs, but on a stock-by-stock basis, you can find some really high-quality companies down 50%, down 60%, and even more that are earning money, generating cash, not promising the future and delivering nothing, but actually cash-generative companies that got caught up in this headwind. That'll be great opportunities when you look multiple years out.
All right, I like the well laid out argument with a lot of kind of indicators backing you up on the idea that maybe we have hit the bottom here. You kind of pointed to some possible opportunities, maybe some of the safest or best buying opportunities, although those two aren't always the same for one another. But let's dig into that a little bit more. Where do you think are the biggest or best opportunities in the market if, again, we're at the bottom, we're looking to climb back up, and we're looking to buy right now?
Okay, well, this is going to be very unpopular, Alicia, but in the last week, in the last tightening cycle, 2015 to 2016, the 12 months beforehand, biotech fell 53%, and China tech, Alibaba, fell 52% in the 12 months before the rate hike on the fears of the tightening cycle. After the first rate hike at the end of 2015, both biotech, the sector, and China tech, in the case Alibaba, found their bottoms. And over the tightening cycle, the Fed raised rates from 25 basis points to 225 basis points over the next 2 years. Biotech was up 140% off of those lows, and Alibaba was up 258% off of those lows. Now, history doesn't necessarily repeat, but I think sentiment has become so pessimistic in these groups because the narrative is they can't perform in a rising rate environment. And the reality is most of the rate hikes that are going to happen, if not all, in the coming 6 to 12 months, are largely priced in with a 2-year yield over 2.62 today. That's priced in quite a lot of rate hikes moving forward, and I think these groups can start to bottom, and I think the fears of tightening are overblown. The fear may be a lot worse than the actual reality, and that's why in the last week, every up day you've seen KWEB, the China Internet ETF, and XBI, the NASDAQ equal-weighted biotech, they've been the top two performers on every green day since you had that flush from Melvin Capital.
All right. I think it is a bit unpopular, kind of some of your takes here, but bullish on biotech, bullish on China tech in China. We actually have in the 10 o'clock hour a full segment on China right now, kind of, what investors should consider there. So if anyone's kind of considering some of those calls you're making, stay tuned for that at 10 o'clock. Before I have to let you go here, got to talk the Fed, right? Because that's obviously something that has been major in the market. A lot of people trying to really understand what the Fed is going to do to tamp down inflation and if its current kind of strategy is truly going to work here. Obviously, the Fed's signaling 50 basis point hikes over the next couple of meetings here. But there has been, especially with this pullback, the idea that the markets are actually pricing in a 75 basis point hike. Where are your thoughts in terms of does the Fed really get even more hawkish and even consider a 75 basis point hike after telegraphing that that's not on the table?
Yeah, I don't think so. I think what you're going to see is a slow and steady hand from Jay Powell moving forward. And this week, it's very interesting. You've got FOMC speaker every day of the week with Chair Powell speaking tomorrow. And rarely at or near with, markets down near bear markets, when they parade out five or so FOMC speakers, it's rarely to talk the market down. My guess is you're going to start to see some whiffs in coming weeks of a potential dovish pivot, and that's going to be contingent upon obviously the core CPI numbers coming out later this week, the CPI numbers coming out early next month. Because if you look back to last year, Alicia, May was the biggest spike in inflation. So the base effects, it's going to be much harder to have a really bad number for May than it was for April. So I think we're going to start to see those numbers come down, and that's going to give the Fed reason to start to moderate maybe just the 250 basis point hikes, and then they might even go down to 25 after that. and that could effectively be the terminal rate if we see inflation come down to 4.5%, 5% before the end of the year.
Thomas, as usual, always great to have you on. Such great insight. Thomas Hayes, chairman of Great Hill Capital. Thanks again.